Welcome back. Today we're tackling something that sounds a little formal but can completely change how you raise money: investor readiness assessments. What they are, how they work, why they matter, and what you actually get at the end. If you've ever wondered, are we truly ready to pitch? Or why do investors keep going quiet after that first meeting? This episode is for you.
And if you're thinking, we'll just practice the pitch deck and we're good, I love the optimism. But investor readiness is bigger than the deck. It's really about whether the whole business can stand up to investor scrutiny without collapsing under basic questions.
Exactly. So let's set the tone. An investor readiness assessment is basically a structured way to evaluate how prepared a company is to raise capital. It's like a pre-flight check, but for fundraising.
And it's not just, are you a good business? It's, are you investable right now, in this market, under the typical expectations of professional investors? There's a difference.
Let's break down what it actually looks at. Most assessments cover a few core areas: your market and positioning, your product and traction, your financials, your team, your go-to-market plan, your legal and operational hygiene, and the fundraising strategy itself.
Which means it zooms out and zooms in. Zooms out to ask, is this a venture scale opportunity or a different kind of business? And zooms in to ask, do your unit economics make sense? Is your cap table a mess? Are your contracts assignable?
Let's go step by step. First, the story and the strategy. Investors are buying a narrative backed by evidence. An assessment will test whether your narrative is coherent. Are you solving a real problem? For whom? Why now? Why you? And what's the wedge into the market?
And it will test whether the story matches reality. If your deck says you're enterprise SaaS but your customers look like small businesses paying on a credit card, that mismatch gets flagged fast.
Second, traction. Here's where founders sometimes get defensive. But the point isn't to shame you for not having huge revenue. The point is to understand your proof points. Traction can be revenue pilots, retention, waitlist, usage growth, partnerships, clinical results, procurement progress, or even a credible path to any of those.
And an assessment will ask the uncomfortable but necessary question: what does your traction actually demonstrate? Momentum, product market fit, or just activity? Because investors can tell the difference between movement and progress.
Third, the numbers. In an investor readiness assessment, financials are not a spreadsheet exercise for its own sake. It's a clarity exercise. Do you understand your margins, your burn, your runway? What drives your revenue? What's predictable and what's not?
And are you setting expectations that an investor can believe? If your forecast says you'll 10x revenue in 12 months, the assessment asks, what input assumptions make that possible? Headcount, sales cycle, conversion rates, pricing. It forces you to connect dreams to drivers.
Fourth, the team. It's not just resumes. It's coverage. Do you actually have the capabilities to execute? And if not, do you know the gaps and have a plan?
Because investors aren't expecting perfection. They're expecting self-awareness. A team that says, we don't have a senior sales lead yet, and here's our hiring plan and interim approach, often reads stronger than a team pretending everything is handled.
Fifth, operations and legal readiness. This is the part nobody wants to talk about until it becomes a deal killer. Things like, is your company properly incorporated? Are your IP assignments signed? Are your employee and contractor agreements in place? Do you have clean financial records? Any weird customer contract terms?
And cap table hygiene. That's a big one. If you've got ambiguous equity promises, too many tiny shareholders, or early safe notes stacked without a strategy, an assessment will flag it because it can complicate the next round.
So, how does an investor readiness assessment actually work? Usually it starts with a data collection phase. You'll share materials: your pitch deck, financial model, KPI metrics, customer pipeline details, incorporation documents, maybe product demo access. Sometimes there's a questionnaire too.
Then comes the interview layer. A good assessment involves conversations. Not only with the CEO, but often with a technical lead, a commercial lead, maybe someone responsible for finance or ops. The point is to understand how decisions get made and whether the team can defend the strategy.
After that, there's analysis and scoring, or benchmarking. Some assessments are very structured, with categories and maturity levels. Others are more narrative, a set of findings, risks, and recommendations.
And then you get an output. And the output matters, because it's the whole reason to do this. The best outcomes are not a pass-fail stamp. They're a clear view of where you're strong, where you're exposed, and what to fix first.
Let's talk about why it's important. I group the benefits into 3 buckets: speed, credibility, and focus. Speed, because fundraising is already slow. If you enter it with messy materials, unclear metrics, and unresolved legal gaps, everything drags.
Credibility, because investors are evaluating not just the idea, but the team's ability to operate like a real business. If you show up prepared, tight story, clean data room, consistent numbers, clear plan, you signal competence.
And focus, because founders waste an unbelievable amount of time chasing the wrong kind of money. An assessment helps you figure out what type of investor fits your stage, your sector, and your model. Angel, seed fund, strategic, revenue-based financing, grants.
Plus, it helps you choose the right timing. Sometimes the most valuable conclusion is, don't raise yet. You're 3 milestones away. That's painful, but it can save you from a weak round with bad terms.
Let's make that tangible. What are the typical outcomes you can expect at the end of an investor readiness assessment? 1. A readiness rating or maturity score across categories. 2. A prioritized action plan, usually with quick wins and deeper work streams.
3. Clearer fundraising materials. Often you'll end with a sharper pitch narrative, better metrics framing, and a list of missing assets, like a 1-page snapshot, a customer case study, or a refreshed financial model.
4. Data room structure. Some processes help you build a simple, investor-friendly folder setup so that when someone asks, "Can you share diligence materials?" you're not scrambling.
And 5. Risk flags. Not to scare you, but to protect you. Like, your pricing is inconsistent across customers, your churn isn't measured properly, your security posture is weak for enterprise buyers, or your gross margin doesn't support your growth plan.
Now, let's address a common misunderstanding. Investor readiness assessment is not the same as investor matchmaking. It's not a list of names to email. It's the work that makes those emails actually convert into meetings, and those meetings convert into term sheets.
And it's also not just branding. Being pitch ready isn't about looking polished, it's about being auditable. If an investor digs, do they find consistency or chaos?
So, when should someone do this? If you're planning to raise in the next 3 to 9 months, it's a great time, early enough that you can fix issues, but close enough that the recommendations are relevant.
Also after pivot. Or after you've had a few investor conversations that stalled for unclear reasons. Or if you're a first-time founder and you want to avoid learning everything the hard way.
Let's do a quick mini checklist people can mentally run through. If you can't clearly answer these, you're probably not fully investor ready yet. What's your ICP, your ideal customer profile, and how do you reach them? What are your top 3 growth levers? What's your runway and what does success look like by the end of it? What's the single biggest risk in your business right now?
And I'll add one. What exactly are you raising for, and how does that money turn into measurable milestones? Investors want constraints. We're raising to grow is vague. We're raising to hire 2 sales representatives, shorten cycle time, and hit $X MRR with Y% retention is a plan.
Finally, setting the tone. Fundraising is emotional. It's easy to take feedback personally or to interpret no as a judgment on your worth. An investor readiness assessment reframes fundraising as a process problem you can improve, not a personality contest.
That tone shift is huge. Because when you treat readiness like something you can build, like product, you show up calmer, more prepared, and more strategic. And that's when fundraising starts to look less like begging and more like partnering.
So here's the takeaway. An investor readiness assessment is a structured way to identify what's working, what's missing, and what to do next before you step into the market. It's about turning uncertainty into a plan.
And if you're listening and thinking, okay, I want that clarity, start simple. Gather your materials, list your assumptions, clean up your basics, and ask someone credible to pressure test the story and the numbers. The goal isn't to be perfect. It's to be ready.
That's it for today. Next time, we'll talk about what investors actually look for in a first meeting and how to lead that conversation instead of reacting to it.